Good afternoon, everyone. We're just going to wait just a couple of minutes for people to join. All right, we will get going. Good afternoon again. My name is Josh Stripmatter, and I would like to welcome you to Stripmatter Wealth Smart Money webinar series. Thank you for joining us today. Our presentation is titled The AI Boom, Breakthrough or Bubble. For those of you that don't know us, we are Stripmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth, Texas. We specialize in investment management, financial planning, estate planning, and real estate investing. We've been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping before we get started. All of you have access to the chat feature. So if you have any questions, please don't hesitate to type those in and we will be happy to answer those for you. Also, we will be sending out a replay of today's webinar via email. So if you missed something, don't panic. You will have the ability to watch this again, and you are welcome to forward this presentation and any of our presentations to your friends and family if you think that would be beneficial. Today's webinar is meant to be purely educational and not meant as tax or legal advice. Please talk to your licensed professional before taking any action on any of the information in this presentation. For more information, including key disclosures, please visit our website at stripmatterwealth.com. Now, let me introduce our speaker today. Tess Severin Butler is the lead portfolio manager on the Severin Investments ETF-only models and portfolio manager on the firm's other investment strategies as well. She graduated from the University of Alabama, cum laude, and then from Washington University School of Law. Tess has been with Severin Investments for the last 8 years, but really grew up with the firm since she manages portfolios with her father, Jeff, as a team. When Tess isn't working, she is teaching her 2-year-old son important life skills such as how to sing the ABCs, the preamble to the Constitution, the Presidents, and the University of Alabama fight song. So without further ado, I'd like to introduce Tess. Tess, good morning to you.
Good morning, Josh. Thank you for having me today. I'm really excited to be here to present this topic to you all. So I'm going to go ahead and share my screen here.
Absolutely. We see your screen. Thank you.
Wonderful. So today we're going to talk about the artificial intelligence boom and whether we are in a technological breakthrough or just a bubble. And today I've got actually NVIDIA's new Blackwell chip as the cover of my on the front page of my presentation here. And this, in a few months, is going to be the most advanced chip that can run AI models on the market. So it's very exciting. This is a technology that has absolutely moved markets, but it's not just about the market because it's changing our lives and it's changing the way we do business. Regardless of what's happening in the market in the future, this is around to stay. I'm going to add my own disclosures in here. We're an asset management firm. We take positions in some of the companies I'll be talking to you about today. But I'm not recommending that you buy or sell anything here or giving you any financial advice. I recommend talking to your financial advisor, such as the Stripmatter team, if you have any questions about your specific situation. So let's get started. Today, we're going to learn about AI and how it interacts with our economy. That way, when you're watching the news, you hear these buzzwords, you hear about the companies that are involved here, you kind of know what's going on. We're also going to compare the AI boom to a previous tech boom / disaster that you might remember, which is the dot-com bubble. And we'll discuss some future expectations and risks that are prevalent in the industry right now. But I want to start by explaining to everybody why this matters to a portfolio manager or to a financial advisor that you might be working with. And so I decided to put together this chart to sort of illustrate it. The white line here, it's a little busy, so try to follow along. The white line here is the S&P's performance over the last year. I updated this a couple of days ago. Things are a little different now. The S&P is probably up 21% right now over the last 12 months. And then I've got a bunch of other lines here also on this chart. And those represent the 11 sectors of the economy. The economy is broken up into 11 major categories or industries. So think like technology, communication services, utilities, consumer staples, energy, and so on. And each line represents one of these 11 industries. The two that I've highlighted here that are way above the S&P are technology and communication services. And one thing you may notice about this chart is that technology and communication services are the only two sectors that have outperformed the S&P in the last year. And when I say outperformed, they have buried the S&P, as you can see. The only other sector that's even come close is financials. Financials is about right in line with the S&P over the last 12 months. Nothing else, everything else is quite a bit below the S&P, as you can see here. What do technology and communication services have in common? You probably know where I'm going from this because this presentation is about AI. So it is artificial intelligence boom that is driving these sectors right now. And communication services, though sounds like it might be telecom companies like AT&T, actually includes a lot of companies that you probably think are in the tech sector, like Facebook/Meta and Google. So keep that in mind, and that's why these two sectors here are very highly correlated. There's a lot of overlap here. So what is artificial intelligence? What makes it so revolutionary and exciting is that these computers and machines can now simulate the human functioning, human brain, functions like a human brain. They can actually solve problems. And even though generative AI, which is what we're going to really focus on today, is really exciting and new, you actually interact with artificial intelligence every day, whether you know it or not. If you looked at your phone today and it recognized you and unlocked, that's artificial intelligence. If you used autocorrect today, you used artificial intelligence. If you used your GPS and it told you how long it would take to get somewhere, how much traffic there was, and if you needed alternate routes, also artificial intelligence. If you talk to Siri today, artificial intelligence. If you Google something, same thing. So it's already all around us. Some of the more exciting versions may be self-driving vehicles or, the ChatGPT chatbots. A lot of like Meta and Google are coming out with those as well. But really what is really driving the artificial intelligence market right now is this generative AI technology. And the way it works is generative AI can actually learn. If you ask it a question, ChatGPT a question, and it gets the answer wrong, and you tell it got the answer wrong, it will learn for next time, just like kind of like a human does. And the way it happens is through the chip that is used. That is the brain of the AI model. NVIDIA chips have these layered electrical nodes, and they're meant to simulate the structure of the human brain. These chips can process and analyze massive amounts of data, and they can actually start to draw analogies and inferences from that data. So that when you put in a prompt, such as write me a cover letter in the style of Shakespeare, highlighting XYZ experiences, it can write you an excellent Shakespearean cover letter. And although that doesn't seem that useful, ChatGPT and other generative AI models are useful for a variety of different things. Again, a big hallmark of generative AI is that it learns through practice and training. It doesn't require human intervention to improve. But also important to remember is that this is still weak artificial intelligence. Strong artificial intelligence or artificial general intelligence would be a machine that is sentient, that is aware of what's going on. And none of these machines are. And although, Tesla and Google, Meta, they're all really after that artificial general intelligence, for better or for worse. I put together a supply chain talking about the basically the infrastructure for a AI chatbot like ChatGPT. And I really did it to kind of highlight the sectors of the economy and the industries that are involved in putting together a generative AI model. And plus, when you watch the news, you hear about companies like NVIDIA, Taiwan Semiconductor, Amazon, what have you. You understand where they fit in this whole infrastructure. So when we're talking about AI models, what makes them so special is their brain. So we need a brain to start with. NVIDIA engineers design the most advanced chips on the market right now. They are the king of artificial intelligence chips. This is really the most important and innovative part of the whole process. You've got some other players here like Broadcom, AMD, Intel, and a few others, but NVIDIA is where all of the massive innovation really occurs. But believe it or not, NVIDIA does not actually manufacture its own chips. Once they design the chip, they send it to a company called a foundry for fabrication. That's basically manufacturing the chip. Taiwan Semiconductor, you've probably heard of them. They are the largest chip manufacturer in the entire world, and they manufacture over 90% of these chips that can support AI models. So they're very, very important and a huge value add to the supply chain. Finally, the chip goes back to NVIDIA or various other companies that NVIDIA contracts with for final assembly. And really, this is the least important part of the whole process. So we won't spend too much time on that. Finally, you've got your data centers and cloud service providers. You've got companies like Microsoft that are in tech, Google in communication services, or Amazon, which is actually in consumer discretionary sector. They are all exposed to this software subsector, which lives in technology. And they own these giant data centers with servers and chips in them, and they provide cloud service. And this is where an engineer would go to build an AI model like ChatGPT. They would use this infrastructure here. The other important aspect of this AI ecosystem here is the hardware. I mentioned that the brains have to run on something. They need the energy to run. And so the server provides that. Super Microcomputer is a company that probably no one heard of a year and a half ago. Now they are the most important provider of servers in the AI industry. They have a patented cooling technology that helps the server not overheat from these super, super powerful chips. And just to kind of go over how these individual companies have done compared to the S&P, I think over the last year, S&P is probably up like 21%. Microsoft, Google, Meta, these companies all have exposure to AI, though they're pretty diversified. They've still outperformed the S&P. But when you look at companies who are just pure AI plays, like Taiwan Semiconductor and NVIDIA and SMCI, you see that they have absolutely crushed the market. AI has really driven the technology sector over the last year. And actually, this isn't new. It's been happening for a few years now. NVIDIA up 2,700%, SMCI up 4,000%. These numbers are almost impossible to fathom, and yet they've happened. So of course, when you see something exciting and new like this, and the market's all jumping on it, we have some critics emerge. And a lot of people are starting to look at this outsized performance from these AI companies and say, hold on a second, this is too much. I literally can't fathom this. NVIDIA accounts for 30% of the S&P's gain this year alone. But when you combine that with Microsoft, Google, Amazon, and Meta, you're up over 60%. And that's just a purely technical indicator. The other thing that's kind of raising some maybe yellow flags here, or red flags for some, are the high valuations we're seeing on some of these companies. When I look at a company's valuation, that's their underlying fundamentals and what we're willing to pay for the fundamental value of a company. I like to look at the forward PE. That's the price of the stock divided by the future earnings per share that's expected for this company. So right now the PE for forward PE for the technology sector is 31 times earnings. On average, it's 21. So it's higher than normal. That means technology stocks are more expensive than normal. People are willing to pay, on average for a technology stocks, $31 to own $1 of that stock's future earnings. Forward PEs on some of the really hot tech stocks like right now, like NVIDIA, are 40, and we've seen them, at 45 just a month ago. So the forward PEs are higher than average right now. So a lot of people are saying these companies might be a little overvalued. But before I talk too much about that, let's look at the dot-com bubble. I'm sure many people here remember it. It was the tragedy that followed the invention of the internet, which was also a revolutionary technology that changed everything about the way we live our lives. Between 1995 and 2000, the NASDAQ, which is a tech-heavy index, just exploded. Technology stocks were huge. We had very high valuations, but really a lot of tech companies with little to no profit or underlying fundamental value, and easy capital. Easy capital is, when we talk about capital, I'm talking about the money flow into the funding for these companies. You had a lot of venture capitalists and a lot of the public just throwing money at any company that had .com at the end of their name. It was just an absolute frenzy. Between March 2000, October 2002, the NASDAQ crashed 78%. By the end of 2001, most of these .com stocks were completely bankrupt. They didn't really have underlying fundamental value anyway. So there wasn't really anything there when the share price started slipping. And even the really big players that were valuable and still exist today, like Oracle, and Intel, and Cisco, they lost 80% of their value. So huge crash, and it was really a tragedy. So let's compare the dot-com bubble to what's going on in AI right now. Both of these, we've got a huge innovation that happened in the tech industry, and it really will change the way we do business going forward. We have, again, outsized performance in the tech sector and high valuations. But there's a lot of differences here, I believe, as well. First, with the dot-com bubble, we had a lot of startups with no profit, no underlying value. The AI boom is not like that. We have a lot of really big stocks that have experience in technology industry. More than that, though, we see the contracts that they have for their AI products and the sales. It's actually coming to fruition. To start a company on the internet selling, whatever, dog stuff, books, unless you're Amazon, it doesn't require much skill. A lot of MBAs were dropping out of college and opening up these .com companies. In contrast, the AI boom requires a lot of skill. Not just anyone can build an AI model that works or is successful. And so there's a big difference there in the skill level required to even get into this industry right now. And you can see the capital is a little tighter. So we do have a lot of money going into AI, but it's not just being flung everywhere. During the dot-com bubble in 1999, 2000, there were over 600 IPOs in technology alone. Compared to 2023 and 2024, there were only 7. So only 7 new companies went public and asked the public to become owners of their company. Also, while we have high valuations right now, it's still not touching the height of the dot-com bubbles. The NASDAQ, the forward PE is 29 right now. On March 10th, 2000, the day before everything started to go south, the NASDAQ's PE was 51. The forward PE on NVIDIA, the king of technology right now, is 40. The PE on Cisco on March 10th, 2000 was 131. So people were paying $131 for $1 of Cisco's future earnings. Very, very high. And then, in the dot-com bubble, it was a frenzy. We had this irrational bullish sentiment. 75% of people at the time thought the market was just going to keep going up. The bullish sentiment in June of this year was much more reasonable, around 44%. But just because I don't think that the AI boom is a bubble like the dot-com bubble and going to lose 80% of its value and just see hundreds of companies become decimated, I don't think that's going to happen at all here. I think there's going to be a lot of value and a lot of growth in the future, but that does not mean that it's a straight line up. And I'm sure we will have a pullback at some point here. We've already seen some more volatility here in tech, and there's a few reasons for this. First of all, we do have some high valuations right now, and these companies are priced for perfect earnings and exceptional innovation going forward. And if they don't meet, or if they merely meet expectations, you're going to see volatility. Just yesterday, Google had good earnings. It was fine. It was boring. And the whole tech sector, all of these AI stocks had huge pullbacks because of it. Even though some of the other AI stocks had great earnings. So high valuations create opportunities for more volatility. It's not necessarily a bad thing, though. That doesn't mean that there's not a lot of growth potential and upside to be had. Some other issues are geopolitical and macroeconomic events. These are all global companies, and they're very sensitive to geopolitics. Just a week and a half ago, President Biden said that he wanted to toughen trade restrictions with China when it came to AI technology. And, we had a pullback in NVIDIA and a lot of these AI stocks that, they want to do a lot of business with China. On the exact same day, former President Trump, who might be our next president, said that he wanted Taiwan to help pay for their own defense against China. And of course, Taiwan Semiconductor manufactures more than 90% of these AI chips, is right in the middle of that conflict. And so that created some volatility there in that sector too. So the AI sector, regardless of innovation, is very exposed to our trade relations, specifically with China and Taiwan. Finally, competition and innovation. NVIDIA is the king right now. Cisco was the king in 2000. It just won't last forever. NVIDIA can't innovate at just incomprehensible speed for the long term. And so at some point, you'll see some competition and more advanced chips coming from a different company. And you even see this with servers already. Like I said, a year ago, no one had heard of Supermicro Computer. Now they have huge contracts. They have the best servers on the market, and it's because of their patented technology. So as we see more innovation coming from other companies, we'll see growth in those companies and people taking their capital away from companies that may be less innovative, like NVIDIA at that point. But none of this is to say that technology is not worth investing in. If you pull any sector, I could do a presentation on any sector of the market, and you're going to have risks in those sectors. And so that's why we want a diversified portfolio. A big portion of the S&P is exposed to tech. And if you haven't been in tech, you've really missed out on pretty much all the gain of the S&P over the last couple of years. So there's a time and place for risk, and that's what your advisor, like Josh and his team, are here to help you with and help you manage so you can reach your goals. So I just want to thank you for your time today and see if anybody has any questions before I go.
Great job, Tess. Thank you so much. That was
Thanks.
very interesting and a lot to unpack there with all of that information. But yeah, if you want to type in your questions into the chat feature, we will answer those questions for you. In the meantime, I'm going to switch over back to our screen here. Give me one moment. And folks, if you have questions, you're welcome to give us a call or email us at info@stripmatterwealth.com. Phone number is 817-210-3444. And if you'd like to schedule a complimentary wealth strategy meeting, you can click on that QR code and that will take you directly to our scheduling app and you can schedule a meeting with us. If you'd like to meet over Zoom or in person, you can do either. Okay, we've got a couple of questions here. Let's see here. Well, no questions, just excellent presentation. So, Tess, looking back at some of those numbers, you know, it's been a long time since I've looked at the .com crash, but those were astonishing to me. I
Yeah,
think 600 IPOs, 630 IPOs, and then some of those forward or those PE ratios were just outrageous.
they were.
So
Yeah,
that
they
really
were.
puts it into context in terms of where we're at today and where we were at a long time ago, and it really doesn't compare at all. Um, which makes you think, you know, how much room do we have to run with some of these stocks? What do you think?
Well, I think if we saw valuations like that, we would be in some pretty serious danger there. But you know, I think there's definitely room to run here. You know, we still have a lot of innovation happening. I mean, NVIDIA's Blackwell chip hasn't even hit the market yet. We've got a lot of contracts that have come to fruition here. You know, big companies like Meta and Google and Microsoft have committed to buying these. So I think we still have a ways to go with this innovation, and something about valuations is that they get adjusted up. I mean, NVIDIA has a habit of increasing their earnings expectations, which lowers their PE. And so it's just something to keep an eye on. I think I wouldn't count out technology, even though we've had a big run. But I do see a lot of volatility starting to happen in the market. I think as you see the VIX, which is the volatility index, climb, you're going to see a lot more downside in technology. And so that might be a good way to kind of manage your
Yeah, and
expectations on tech.
of course, we saw a big pullback yesterday
We did.
and
Yeah.
a little bit of a recovery today, but it seems like we've had probably a couple of weeks now of the tech stocks pulling back. Um, so yeah, it's always hard to know. It's always hard to time in the market, but
Yeah.
we
I
are
wish we
starting
had
to
a
see a
crystal ball.
pullback here. Yeah, and
Yeah.
I read a lot, and I know they're talking now about some of the asset classes kind of turning over and going into some other
Yes,
asset classes that are outperforming. Small cap stock as an example. Do you have
absolutely.
do you have any comments on that?
Yeah, so you know, we've definitely seen more of a rotation to small cap. Also utilities, healthcare, consumer staples, some of the stocks that have been ignored. We're really seeing on the discretionary, on the consumer side, the inflation's really kind of hitting home with people.
Yeah,
And so a lot of these discretionary companies, consumer discretionary is a sector that people, it's the stuff you need or want but don't necessarily need. So like toys and you know, shoes, like you're gonna see like Nike and Skechers and Dick's Sporting Goods and your Hoka's that you go buy. All those companies that sell those things are all discretionary, and they're all lowering their outlooks for the rest of the year
yeah.
because people are kind of tightening their belts.
Hmm.
Um, but yeah, it's we've we've definitely seen the increase in activity in small cap, and you can get into tech that's small cap too. I mean, SMCI is I think it's a large cap now, but it was
Hmm.
small cap a year ago.
Yeah,
But there's still some small cap and some small mid cap stocks out there. That have a lot of value, and you see there's a lot more upside, and the PE ratios are a lot lower on them. Um, I think it's I agree that I think that they're going to be performing a lot stronger. I don't think that the straight line up for tech is going to continue
yeah,
into next year. I think there's a lot of long-term value in these big tech stocks that are really heavy in AI, but you know, in the short to midterm, definitely diversifying out more into small cap
Sure.
and some of these more unloved sectors is a good idea.
Yes, we've got a question. What happens when the Fed cuts rates?
It's a great question. That's why we're seeing a lot of excitement in small and mid cap right now, because conditions are very tight for small cap companies. It's hard for them to get loans. So when the Fed cuts rates, we expect that to really loosen up. And that's why small cap is doing so well. And some of these more unloved sectors or more value plays, they're doing well because when the Fed cuts rates, we expect it to be easier for them to do business. But I still think, again, I think in the short term, that's spending some money that's in the market away from tech. So you might see a pullback in tech correlated with that. But also lower interest rates make it easier for these big tech companies to do business too. So you may see some of the money sitting on the sidelines get kind of funneled into the market. The other thing you're going to see with lowering rates, people are going to be pulling out of these money markets and super short-term treasuries that have super high rates right now and either diversifying into longer-term bonds or putting it to work in dividend stocks, which have both growth potential and pay you to wait. So that's kind of what we expect as rates start to decrease.
Yeah, interesting. We have another question. Apart from individual stocks, what are some options for investors who want to dip their toe into the AEI market?
Yeah, so there's XLK is a technology ETF. So you can use there's a lot of sector ETFs out there, some subsector ETFs as well that I know are specialized in AI. So you can definitely get into the AI market with an ETF, but also just if you're owning an S&P 500 index fund, you're probably about 30% exposed to tech anyway. I think if you're invested in the market right now, unless you're trying not to be exposed to tech, you are somehow exposed to tech. But you can increase your exposure. The NASDAQ has a lot of tech exposure. Those sector ETFs, you can just go straight technology sector. You can also look at some subsector. There's definitely AI ETFs. And I'm definitely in St. Louis here. That's the arch behind me.
Yes, somebody just asked you. Are you from St. Louis? Yep. Well, great. That's all the questions that we have. So I want to thank you again for your great presentation. Very interesting. And we look
Thanks,
forward to
Josh.
having you back again.
Would love to come back. Thank you for having me. And thank you everyone for listening and putting up with all of the numbers and data.
All right. Well, Tess, thank you so much.
Have a nice day. Thank you. Bye.
Thanks. Bye-bye.